Everyone keeps asking the same question. When's the AI bubble going to burst? Well, honestly, I don't think it will. Not in the way that you think it's going to burst, because AI isn't hype anymore. It's not like the .com world where as soon as you had .com on the end of a website, they threw money at it. Well, John Smith Shed's .com ain't here anymore, but the internet still is. And I think that's what this is all about. You see, AI is everything. It's in our mobile phones. If you ring up to pay a bill, it's AI you're talking to. And I was reading a news report the other day where AI was actually giving the interview to a guy wanting a job. So it ain't going to disappear. It's a tool that's inbuilt into our lives. So I don't think it's a question of AI dies and disappears, the burst. I think it's a case of which company stays and which one doesn't. That's the question. Who is going to survive the battle? Because there's massive amounts of money kicking around and not all of them are going to live.
I am invincible!
So who is going to survive? Well, because AI, as I'm saying, is part of the infrastructure, it's everything. From just basic getting your groceries, paying bills, to actually helping operate companies now. It's entrenched. Because if you look at it from a different angle, nobody sort of looks at the market and thinks, oh, electricity's overvalued. They look at the company that provides the electricity. Now, when you've got a brave new world like what this is, you're going to have the giants at the top. The Nvidias, the Googles, the Facebooks, everything. The granddaddies of them all. They've already got a lot of money. But then you've got a flood of startups coming in. Now, they're going to revolutionize the industry and everything is going to be rosy. The thing is, not a lot of them are going to survive. They're basically somebody else's work in a different wrapper. So the clones of the original companies. Now, that's where the problem lies. Those are the ones that are going to go pop. And people will put a lot of money into them thinking it's going to be the next big thing. Well, electricity's already here. So is there going to be the next big thing in electricity? No. But the companies that already supply the big power, they'll probably survive.
I am not just another substitute. I am here to stay.
So here's the interesting part. Big companies, Microsoft, Nvidia, Google, Meta, all of these sort of things, they're already making money. So they don't need to think, is AI going to work someday? It's already working for them inside of their infrastructure that's already there. So what they'll do is they'll not look at it sort of thinking, the AI bubble's going to burst. They'll just consolidate, acquire, because that's a way. You know, how many times have you heard Google have bought different companies just to acquire the technology that they want? YouTube is a very good example. Google wanted a media to sort of take to the masses. YouTube seemed to fit the bill. They bought it. Bingo. Facebook did the same thing. They bought WhatsApp and all of these different things. So all they do is acquire wealth rather than make wealth, which is different. Well, they are making wealth as well. But what they're doing is they're just seeing something and they're adding it into their fold. And then they consolidate that into their business model. And it adds another revenue stream to revenue streams they already have. Now, when you have companies that are just starting up, they've only got one revenue stream. And if that dries up, they're finished. And certainly with this sort of AI world that we're in, the AI world costs a lot of money. Why does it cost a lot of money? You would think, well, it's just numbers in the cloud and one thing and another, but the cloud needs paying for because there's a lot of data that needs storage. So that storage needs paid for. Storage needs a lot of power. So that means you've got a huge energy bill. Then it also needs cooling down. So there needs to be a water system and a big cooling system. So suddenly this startup has huge costs over and above what the normal man in the street would see. So it's beyond staffing and just a building. There is a big, big business cost. And sometimes if the revenue coming in does not cover that business it goes tits up. And that's basically what the bubble is, what everybody's talking about. It's smaller companies going, but the bigger companies, if they see something in them, they'll just buy them out. So I still don't think it's going to burst the way you think. I think it's going to be a transition, and it'll be survival of the fittest.
Standing dead in the center of the ring.
So this takes me over into how I look at my investments, because we're going to have a quick look at the Vanguard account and see how well it's done. Now, the last update we did on this was on the 11th of April, and today is the 17th. And I am pleasantly pleased with it at the moment, because with world events, all merry hell broke loose. But this is the thing. You never know when a world event is coming, the same as a crash in the market. You can always say, oh, well, the market's too high. Is there going to be a reset and one thing and another? Happens all the time. But if you're investing and you're investing for the long term, these are going to happen naturally. So don't worry about it. Now, the way I get round this is I look at global indexes as opposed to individual stocks, which is why I started this talking about the AI. Because if you looked at just a stock, that might be the one that you get caught with. Whereas if you look at them all, so you put them all in the S&P 500, all of those big companies are in there. Well, if one goes, fine, you've got the others to pick up the slack. Now, if you look at a global index, then you've got all factors of the world that can pick the slack up if one of them dips down. And if it does dip down, don't worry about it, because market cycles return. So let's have a quick look, see what the figures are. So my balance as of today, and I'll show you it in real time as well, is 188,153. So I am really pleased with that, which is a 2.6 gain from a week ago. That is phenomenal. You know, a lot of people would be happy with that in a month. Now, I did put a little bit of money into it, which you can see here. I keep a little track, but it's only minimal. I've only put a small amount of money into this over the course of the last sort of couple of days. And the growth is mainly the index itself. So I'm more than happy with this. I am cock-a-hoots with it. So this is it. This is the portfolio. And what it's doing at the moment, it's over the last rolling year, I've managed to put a shade over £50,000 into it. It's a rolling year, so that money will go up and down. This year, I'm looking to put personally into it in and around 25,000, maybe 30,000, and then see if it'll just grow for itself. Now, the investments returned to me in that year 37,000 quid. Now, to me, that is phenomenal. All right. And the way I do it is I've got a little direct debit up, and I just put a set amount in each month from my salary. And then when I've got spare money, I drop it in here as well. Now, it's not all rosy. We are now running at all-time highs. So the highest it was 181. And now, as you can see, we're at 188. But if I flick this into monthly, you will see how volatile this can be. It lost 10 grand in March. Obviously, we had the Middle East kicking off and one thing and another, and the energy crisis came into play. All merry hell broke loose. So I still put money in, a decent amount of money, and that kind of offset the losses a little bit. But it also meant I was buying at a good price, because as the market comes down, I just add more into it. It's called DCA, dollar cost averaging, and it works very well. Now, these are the investments returns. Now, I had a bit of a rough time in December, November. You know, red marks, that was a belter. But really, across the year, it's been phenomenal. It's done incredibly well. Now, the investments that I look at, I keep it relatively simple. You know, there they are there. So they are just global funds. I have the FTSE Global because it's got lots and lots of companies in and it's across the board. And then the ASG Global, what that is it's an ethical and emerging markets global. So I've got exposure from both sides, and it's also really cheap. So that's kind of why I do it. Now, it's all bundled together, and it's done under tax wrappers. So there is an element of ISA in here. There's a pension fund and there's standard. The reason being, I can put in the 20,000 of ISA, which is currently the tax-free allowance at the time of the video. And if I put it in the pension, I get a tax incentive from that as well. But I also want ready cash, so I just use a standard account for that. I don't need to take it out week on, week out, but it can go in there, and if I need it, I can get hold of it. And then that means the money's working for me all the time. So I'm pretty chuffed with that. And that's what we do. Just put the money in and let it grow. If it drops back, and it's one of the reasons I'm doing this week on, week out, is you will see it won't worry me. In fact, if it does come down, I'll just buy more for when it goes up. It'll make me more. So if you enjoy this journey and you want to see more of it, do hit the subscribe button. Makes me sort of want to do more and show you more. If you're stuck, I'm very easy found. I've been in and around the markets for 20 years, so I'm okay. I think I've kind of got a grasp of what's going on at the moment. And you'll see that in Scruffy Trader, which is my other channel. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.